At no point in your rambling, incoherent response were you even close to anything that could be considered a rational thought.
And welcome to the Author Your Brand Show. You're going to want to take notes, especially today, because we're talking about one of my favorite topics, not the top one, but top three, money. And if you're like our guest today, he's passionate about financial goals, you're going to want to pay attention to this expert. He's really good at sourcing a variety of capital for a variety of real estate deals in a very unusual, but very, I'll just say community way, where we'll let him tell you about it. But if you're a fix and flipper, if you're commercial, if you just want to understand more about money in general, this is the guy to listen to. So, oh my gosh, I forgot to ask him how to pronounce his last name. This will be a fun topic for the embarrassing host.
Yes.
His name's Kevin. And
Amolsch.
I'm going to try it. Amolsch?
Amolsch, yeah.
Amolsch.
Close. Very close.
What nationality is that?
That's German.
Yeah,
Northern German. Yep.
Very good. All right. So Kevin, thank you for that. Thanks for letting me stumble through that. What's the why should people listen to us today? What are we going to cover here in the next 20, 25 minutes?
Doug, people want to listen to this episode because we help people make money. So we're talking about investing in Main Street over Wall Street, how to diversify into real estate, both passively and actively. So I've been able to create a pretty cool company helping people make money.
I love that. Main Street versus Wall Street. And we talked a little bit before the show started about what that means. And I want to get into that specifically because people think sometimes that they're not playing in the Wall Street world when actually they are. They don't know it.
Yeah.
So we're going to unpack that a little bit later. But before we do, I want to find out more about you and how you got involved with this. Give me your background.
Yeah, I know these are pretty short episodes, Doug, so I'm going to go quick here, but I got started investing in real estate super young. I was just turning 21 years old when I bought my first house.
Nice.
Moved out of that house into another house, and I kept that as a rental. So that was my very first rental property. I was 23 years old, and I was making money every month on the cash flow. I saw the appreciation. It was over 10% at that time. It was right leading up to the bubble burst, if you remember, back in 2001. And depreciation, tax benefits. And you know what? My tenant was paying off my mortgage for me. So I saw all of these aspects of real estate investing and how powerful it could be. And I decided that this is going to be the tool I use to become rich. And then you read books like Rich Dad Poor Dad. Many of us have read that book. And you just get really excited about the business. So I started learning how to do creative financing, started buying 1 or 2 houses every single month while I was in school.
Nice.
While I was working a job. So literally I was walking between classes, calling sellers, asking them to buy their house, right? Trying to get appointments for the weekends because I like to, we call it belly to belly. I like to be in the living room. I want to be in front of you and I want to see if we can work out a deal where we both win, win. And so, I started buying a deal or two a month. And what I learned in that process, Doug, is that the financing piece of real estate is really where the action is. It's how you structure your deal. It's how you write your offers, how you negotiate it. Where is that money going to come from? That's the deal structure. So I just really started focusing on the financing. And in 2006, I started raising private capital. Started out with one guy with $100,000.
Wow.
Now we're about 190 million and we loan multiple states across the country. As you mentioned in the intro, they're highly focused on fix and flip investors. And we do some commercial repositioning and it's cool because our investors make a passive income and then our real estate investors get funding for their deals. So I get to participate in both sides of it.
I love it. I got involved at about the same time right after college, but this was back in the 80s. But it was really great because my very first property, I had accelerated depreciation on it.
Oh yeah.
And boy, that was nice because of course I also made kind of false valuations in some properties because you get like a 10 cap or something. It wouldn't deserve it because you had accelerated stuff. But it's the benchmark for our economy. We all know this. Real estate has been a couple of bubbles here and there, but overall, it's a great place to be. Talking from fixing and flipping houses as a young guy to having almost a $200 million fund. I want to know more about that journey from the first $100,000 somebody invested. Was that in a particular deal? Or do you start with the fund specifically?
So I got recruited to work at a mortgage firm. It's very, very small. So Susan was her name. I worked for her and she specialized in real estate investor financing. And so she had a couple of guys that wanted to lend out their money. So she did a little bit of private lending, just brokering the loans. And then she did all of her regular mortgage broker stuff, right?
Yeah, okay.
So she had introduced me to John, was his name. John had $100,000 in an IRA, and he wanted to invest it into a fix and flip passively. He didn't want to do the work. He just wanted to earn his return.
Right.
So I met John. I spoke with him, and he was on board. So I went to find the deal. The way I did that was I went to one of those real estate like sales meetings, realtor sales meetings where they just pitch their listings, and you're allowed to sponsor those. So I paid my fee, and as a sponsor, I was able to get in front of the room. And I just told the room of realtors, hey, I'm a private lender. I have $100,000. I'm ready to invest it in a deal right now. And and I just got swarmed with realtors. And one of them actually had a deal. It was a little condo.
Yep.
So I brokered the deal, 4 points origination and 15% interest were the rates back then.
Yep.
And I kept 2 points. I gave John 2 points. So that was my first private loan transaction. Nice. I collected $2,000, sort of keeping the lights on until we can get another deal, right? Yeah. And then I just started really focusing in on that niche, and I started doing seminars. This was back even before webinars. So it was all in-person live events. And I would just say, hey, I'm accepting investors, and I've got deals to invest it in. Are you interested? Here's how it works. Funny story. I don't know if we have time to get into it.
I love stories. Yeah, go. We're going to go longer than 30. Go ahead. Sorry.
Okay, so
it's much fun.
One of my competitors, as I was growing, and I had about 10 million under management at this point, and one of my competitors felt threatened by this, and so he calls me. He says,
$10 million? Really?
About 10,
threatened
about
by
10.
that?
Yes, he was threatened by it.
It's a small community. Multi-trillion-dollar economy.
So he calls me up and says, man, hey, Kevin, how did you do on that securities test? And I was like, what securities test are you talking about? He's like, oh, to do what you're doing, you need to be licensed.
Okay.
And I'm like, oh, so I'm like, okay, what's this licensing about? So you know what I did? Here's my mistake, Doug. I called the state of Colorado. I'm in Colorado. The Department of Regulatory Agencies, the Division of Securities. I called them on the phone and asked them if what I'm currently doing was legal. Can you believe this young kid? Like, what am I thinking? So I quickly
what's your address, sir?
Exactly. So I basically on that phone call, I got an invitation into the office. Ooh. And when I got to the office, there's this giant, you ever seen that show, The Apprentice, the Donald Trump? Yeah. So you know that big giant table, so it was that. And I get in there and her name was Cheryl. She sat me down and then in comes the investigator. He's huge. He's probably 6'6" and 250 pounds. Looked like a freaking NFL player. He had his gun. He had his badge. He shows up in the room and he throws his card in front of me. Says, Mr. Amolsch, I'm investigator, whatever his name is. I can't remember. Yeah. And you're under investigation. And this was the start. This was in 2008. Yeah. This was the start when I started Pine Financial. So really the start of my career, I go under investigation with the state of Colorado. And it was intense, man. We had 10 years of everything. Every investor they called that I worked with, every borrower, I mean, everything. Yeah. Well, it turns out I was doing everything correctly. In fact, I was over disclosing is what they told me. I was disclosing more, if that's a thing. It's weird. I was disclosing more to my investors than what the state of Colorado required to broker that transaction.
Okay.
So they were actually very pleased. And I said, you can't keep doing what you're doing. You do need to go get your license. Yeah. But once you get your license, then it's business as usual. So
and what license is that? A securities license?
It's a Series 63 securities license in Colorado. They call it it's a broker dealer. It's a mortgage broker dealer license. So I had to stop, no income, right? And I'm just starting to get started, had a new baby. And I'm like studying my brains out, trying to get this test. There's no class. I'm just like practice test, studying. And I went and took the test and passed it, got my bond and got my license. And then Pine Financial was born. So that's how I got going.
I love it. How long did the process take where you had to pause things and then get licensed?
Yeah. So the investigation itself was rather quickly. I think it was, looking back, I think it was about 2 months time to get the deficiency letter, they call it. And once I received that, then it was just another month or so for me to study, and then get that.
How old were you when that happened?
So this was in 2008. So I guess 30, 29, 29.
Did you expect that when you walked in that room, or did you know?
Gosh, I had no idea what I was doing. I legit didn't even know what I was doing was wrong. My mentor taught me how to do this, right? So I trusted her. Yeah. It's just such a niche. There was no hard money industry. back then. There is now.
Yeah.
We thought it was a Wild West. We just thought we could do whatever we wanted. I mean, don't take advantage of anybody. We certainly weren't doing that, but we didn't know that there was regulation around it.
Would you like breaking out in a sweat when the guy came with his gun and his badge and stuff?
Scared. I was so scared. I was like, how am I going to support my family? Am I going to jail? I didn't know what was going on.
Yeah. No, we
was big.
We did a book
on it. Did I mention he was big?
Go ahead.
I was just saying he was a big guy. He's very
big dude, right? They always think it'd be intimidation factor. No, we just worked on a compliance book for the FTC, and the stories from that guy was just ridiculous because he did 99.999% everything perfectly. Documented stuff, refunds within 24, everything, and he didn't have your story. He had to pay a fine and reset stuff. It was painful. So you don't want to mess with the guys who have blank checkbooks for their legal team. They don't care. It's messy.
That same competitor, maybe 2 years later, called the state and said I was doing something wrong, and so I went back under review, and then I came through that flying colors as well. So both times was totally fine, but it's just a stressful process. It's like a full audit.
I mean, this is for the state of Colorado.
Yeah.
I'm going to guess there's at least $100 billion of real estate loans going through that state. Is $10 million.
This is a pretty niche. I mean, this is a pretty niche loan though, right? Fix and flip. So it's not that much. It's 100 million a month, 150 million a month, maybe in private capital going into single family real estate.
10 million is not a big fund.
No, it's not.
It's friends and family level, really.
Yeah.
Oh my gosh. All right. Well, I'm glad you came out of that with flying colors and dried the sweat off your brow for that one. That's a good one. All right. So you went through that. You learned your lesson early, which was great. How'd you go from that $10 million to almost $200 million fund?
Yeah, and I'm trying to get better at this. I'm constantly trying to get better, and we're doing some really fun, creative things now, and we have some good things happening. But I'll tell you what, the answer to that is grind. It's just work. Like I'm willing to outwork my competitor. So nice. I'm in there doing the seminars. I'm in there writing articles. I'm in there posting on social media. I'm in there talking, meeting for coffees and drinks, and getting to know people. And then look, if you do what you say you're going to do, and your results speak for themselves. So then you just start getting referrals. So hands down, our biggest lead generator is referrals.
Terrific. Yeah. It's, I was involved with this industry back in the day. So I got a chance to meet, Kiyosaki's but actually I was my degree is in radio, TV, and film. So I worked at the TV studio for a while out of college, and in walks Robert Allen for a interview. And so I'm listening to the guy talk, he's, and I'm 21, 22 at the time. Oh, that's really cool, Mr. Allen. I go up to him afterwards and said, how do I get involved in this real estate thing? He said, just come to my seminar, young man, the $5,000 a weekend. I'm like,
yeah, exactly.
Sir, I make $3.10 an hour here as a lighting director for ABC Cleveland. He's like, and to his credit, right? He says, well, just go to the library and check out my book. And I did. And I loved it because I'm young, naive, and I believe every single word in that book.
Yeah.
And I was so impressed. I actually bought a copy, and dating myself, like hardcover copy was $12.50. And I did exactly what he said. And I started buying properties and flipping them and holding. I did a lot of different things. But boy, the stories that I'm sure that we have, I'd love to hear. Let's start with the worst deal you ever did.
Well, the biggest loser I've ever had was I tried to convert a motel into an apartment in Branson, Missouri. So I lost 6 figures on that one.
Yeah.
Probably the worst one, honestly, is the very first one though. And so the quick story, I'll make this pretty short, but I was chasing foreclosures, and I went to one of those seminars as you described, and I was sold on the short sale game. Yeah. If I could create equity through a short sale for the listener is just a bank accepting less than is owed on the loan. So you could actually negotiate equity by reducing the amount that's owed.
Right.
So I was chasing short sales, and I got one, and I had a coach at the time, and the coach said, well, you need to get control of the house. And his suggestion to get control of the house was to get the deed.
Okay.
I later learned that, a contract is just as good to control a property as the actual deed.
Yeah.
So I'm trying to get the deed. Well, this guy's not going to just sign his house over to me. So he asked for $3,000. So I didn't have $3,000 at the time, but I did have $1,000.
Yeah.
So I said, hey, I'll put in the $1,000. I'll bring the deal. You bring in $2,000 to a buddy of mine, and we'll split it 50-50. So I brought in my friend's $2,000. I put in $1,000. We bought the deed for $3,000. He went off and did whatever with his money.
Yeah.
Now we owned a house with a loan on it that was more than the house was worth.
Right.
And we're thinking we're going to negotiate the short sale and make all this money flipping this house. Well, we spent, 6 months on this short sale. The process is rather slow.
Yeah.
And you know what the bank said, Doug? The bank said no. They're not accepting our short sale.
I have so many stories. I'm going to share with you one or two, but I was trying to short my own house during the 2008 dip.
Yeah.
And I'm like, I had a second on it, right? So I'm like, okay, well, let me call them up because they're going to get killed in this thing. So can you please, I'll pay this thing off if you give me a discount on that note. And this was $750,000 home. The second was for half. It was for $350,000. And I'm like, yeah, $200,000. I can get the thing paid off. You'll be whole. I'll work on the first mortgage. Everybody's happy. They said no to anything. Any discount was straight up no. I'm like, all right, you're going to lose.
Yeah, and they did.
6 months later, I'm in foreclosure and it's gone. I'm like, they got nothing. And I think it goes back to you're not talking to a human being. You're talking to some ledger or some number.
Well, they didn't know the storm. Remember back then, no one really understood how bad that storm was.
Right.
So if it was early on, if you're talking about 2008, 2009, somewhere in that range when you were doing this, it wasn't bad enough yet. That foreclosure wave came in like 10.
Yeah.
So it started with Lehman and all of that.
Yeah.
Most of us know what happened.
Yeah.
But the real pain to the banks was more like 10 and 11. So if you were negotiating that early on, they probably did say no. Had you had that same experience in 2010, they would have taken it.
Yeah, I'm sure. Yeah. Tell me about your best one, and I'll tell you mine.
My best?
Yeah.
Oh man, I've had so many good wins. You got to go through some losers to get to those winners. But I guess my best one is I had a lease option, and we could talk about what that is if you'd like.
Yeah, that's my best story is lease option too. I hear yours. Go ahead.
Okay, so a lease option, I tied up a property with a lease that I subleased out. It was a fourplex with a right to buy it for $350,000.
Okay.
Well, it's in Sloan's Lake in Denver, so it's if you don't know the area, it's a very good area, right by the lake, and I locked that up for 10 years. Well, as I got closer, there's a 10-year lease with an option.
With an option that any time in those 10 years you can close on it?
Yep. Wow. And so there's all this development going on around me. So the value of the property is going up, and my price was fixed, right?
Yeah, of course. Yeah.
So as we start getting close to the expiration of my option, there's development going on all around me. And I've already been investing in some development deals.
Right.
So I was like, well, let's develop this lot. And it wasn't big enough to do much with. I could probably tear down my fourplex and build another 4. And I would have made money. It would have been fine, but I wanted it to go bigger. So I started trying to assemble. So I went to the neighbor next door, which was a vacant house. And I was knocking on the door, sending letters, trying to find out who the owner of this house was. Yeah. Ended up finding out the owner, which is not that hard to do. And I found that owner on Facebook and started messaging them on Facebook.
Okay.
And finally got their attention, bought their house, probably paid a little bit over what I paid a little bit over what they could have got from anybody else, but it was so valuable to me because now I can combine the 2 lots.
Wow.
And then now we don't need access to those lots from behind. So the city vacated the alley that was back there. So I combined the alley with these 2 lots and I was able to build 12 townhomes. So we built and sold 12 townhomes, and that was my first $1 million. I mean, it was over that. It was my first.
You're like mini Walt Disney, how they bought up the orange groves in Florida, right? A little sliver at a time, right? Nice.
So it all started with a little lease option that I learned how to do out of a book, like you. Yeah. And it turned into $1 million payday. So that was my biggest. Yeah. That was my first 7-figure win. So that's probably the one that is most impactful to me.
My 7-figure stuff is all a little bit slower than that. I had one big one, but my favorite lease option was a office building that I was driving by every day, looking at this thing, and it was kind of a 70s thing. I need a little uplift, but it was like 40% vacant. but it was in my neighborhood. Like, it was a lot of stuff going on. Like, I can do this thing. And I actually needed a space for my own company. So I did a lease option on a office building. It was small. It had like, I don't know, like 12, 15 units in there. And because it was 40% vacant, I go to the bank and they said, we're not going to loan on this thing. There's no revenue coming in. Not that they support your loan. I'm like, yeah, I know. I go back to the seller and I said, tell you what, I'll give you, I think I said, full asking price if you write a master lease for all the vacancies. So to understand what that is, people, he wrote a lease that actually had to make money exchanged to rent out his own building. On the paper, the building looked completely filled, and it was because the money was coming to support that. It was coming from left pocket to right pocket in his case. But now, since I'm doing the lease, the master lease is written to me. I go to the bank and say, hey, fully occupied building. I'm going to lease it for a year. I need to set the paperwork in motion to close this thing a year from now. Okay. So I moved myself in the one vacancy. The other 4 or 5 vacancies, while I'm there, I filled it up. I rented it out. And the owner, because I'm still leasing, I don't own it yet, he calls us, hey, it looks like you leased it up, so I'm going to stop making those payments. I'm like,
That wasn't the deal.
Nothing in the paperwork about you stopping once it gets leased up. So I collected like 130% rent on the thing for a year. And there's your down payment, folks. I went into the bank, had the money from the seller legally through this master lease thing for the down payment and their mortgage. And yeah, I did like $300,000 on it when I sold it, a couple years later.
That's genius. That's such a great story.
It was so much fun to do that stuff. Because I always say to people, you're not going to find deals. You got to create the deals. I think, I don't know if you agree with that, but
you find problems, right? I just wrote an article and it's, I met this guy and I gotten to know him pretty well. He's got $1 million balance sheet, right? And he was talking to me about how to scale up, how to actually make real money. And he says the people that solve the biggest, most complicated problems make the most money.
Yeah.
So we got to find the problems. And in real estate, it's no different.
Right.
You're not looking for deals. You're looking for problems you can solve.
Mm-hmm.
When you can make that mind shift change, that's when the deals really start flowing in.
Right. Absolutely. Absolutely. So, in terms of the marketplace, I know a lot of people were complaining about the, interest rates. And like you and I, I'm like, you paid 15%, and I think my first house was 12% mortgage, and it's fine. But do you see any big difference in valuations or deal flow with how interest rates fluctuate?
I'm so surprised at how resilient this market is. Now, if you look at office, that's the weakest sector. I don't think anybody would question that.
Single tenant industrial, I think that's danger beyond belief for me, but
oh, we're seeing so much of that, repurposing that, because you cut that up in a small bay, and $3,000 to $5,000 small bay industrial units are flying off the shelf.
Nice.
I mean, in Denver, it's a 0% vacancy on that stuff. So
wow,
I'm not seeing any issues with the industrial side, but office for sure. But here's the thing. It's very localized. Real estate's very localized. I think we all know that.
Yeah.
Now, when you hear like the big building in Fort Worth selling for $12 a foot, right? But that's class A inner city high rise stuff.
Yeah. Yeah.
I mean, we're talking about 180,000 feet vacant, right? Of course it's going to sell for almost nothing.
Yeah.
The suburban office isn't hurting as much. So you read the headlines, offices dropped 40%.
Yeah.
Well, yeah, that's true globally. But when you're tying in this big office tower in Fort Worth, Texas to, a suburban 12,000 square foot office building in, wherever, it's not a fair way to look at it.
Right.
So I think that the market overall has been extremely resilient, even on the commercial side. Right. But cap rates have come up, right? Yeah, especially in the office, as we said, and multifamily, they have come up. But sellers, if they don't have to sell, they're not selling.
Yeah.
So I'm not seeing the price drop that I was expecting. Now, there's still a ton of commercial debt coming due in the next couple of years.
Right.
And when you recast those at a higher interest rate, they're not going to qualify. So I don't know what's going to happen there. So we're keeping an eye on it. But surprisingly, I haven't seen that much impact with the interest rates, which is why inflation is so sticky, right? Yeah. Because we're just not seeing the impact.
Yeah. I never understood, maybe you can help me understand, this is kind of old news, but how come things are so hot during the pandemic? I mean, all this fear and crap going on, how come the real estate market exploded with something so global like that?
Oh, it's easy to explain that, Doug. It's called printing money.
Okay, there you go. 2 words. Yeah, they've just printed up a couple $1 trillion.
Let's just give money away to everybody,
right,
and see what happens to into the economy, right? Of course, it's going to increase the economy,
Yeah.
and now we're paying for it.
Yeah. So what's the best connection for you? What you looking for, more deals or investors? What would be the best thing to help you out?
Yeah, no, we didn't really touch on this, and maybe I should have when we were talking about the interest rates in the economy. Look, banking's in trouble. I really think that that's true. And there's evidence of that because when you see a bank fail, like Silicon Valley, that's the first biggest one, right? And then all of its peers
all the time now too. I'm just like, who's going to click on this ad?
Yeah, and my bank just got acquired. So I don't know how that's going to impact me personally, but there's going to be mergers, there's going to be acquisitions, there's going to be consolidation in the banking industry because banks are hurting right now. And I'll tell you what I'm seeing. I'm seeing the larger banks not make loans because they're hoarding cash for 2 reasons. One, they need to be able to meet withdrawal demands because you don't want to be Silicon Valley Bank again. So they're staying liquid to meet those demands. And they're staying liquid because I believe they're going to be targeting smaller banks to acquire. So if they want to stay liquid and they're not making loans, where are these investors and where are these homeowners going for their money to buy these projects?
Yes.
Where they're coming to companies like us. So I know that's a long way to answer your question, but we are seeing a tremendous demand for our money right now. And the need for me is not more loans because I have more than I could handle. We're raising capital to try to meet this demand. So we're really heavily in the capital raise phase right now.
Got it. Okay. So explain to people what you said, because I understand, private versus, public, but when you go to a bank to borrow money, there's a lot of options to borrow money. And, Kevin's a private lender with private money. There's a huge difference between that and going to, Wells Fargo or something. Can you explain to people the differences and the benefits to that?
Yeah. So as a private lender, we don't have the same regulation. We're not FDIC, but we don't have deposits either. So you're not opening up a checking account and we're not handling deposits. You invest in a fund, like a mutual fund that we manage, and we deploy that capital into real estate backed loans. So everything we do is low loan to value, loans to real estate developers, and they're highly qualified borrowers, highly qualified assets, all of those things. But the benefit here is we don't have the strict banking guidelines. I like to call it, Doug, common sense. We have common sense underwriting. If you could show me how you're going to pay me back, then I want to do the deal. So if you're fixing and flipping, am I relying on your income, your W-2 job income to pay that loan back? I'm not. I'm relying on the quality of the deal and you reselling the asset for a profit to pay me back. When you resell it, then I get paid back, right? So I'm highly focused on the asset over your income. Banks can't do that. They want to see a global cash flow. So banks will turn that loan down. So investors come to companies like ours that are privately funded to do their deals for us. Now, the advantage to the passive investor is, look, you're the senior lien position. So that's the first one in the capital stack, meaning you get paid first. It's the safest position to be in real estate. That's what we invest in. And it's a high risk adjusted return. So if you're looking at 8, 9, 10% return in the safest position in the capital stack, that's why there's a lot of investment coming into the space right now.
Right. Yeah, that's nice. So you're looking for more investors, yeah?
Yes.
Okay. So folks, if you want to get a better return on your money and much safer and deal with not Wall Street, but what'd you call it?
Main Street.
Main Street.
We invest in
Main Street, not Wall Street, and actually talk to the guy who's holding and managing and growing your money. You want to talk to Kevin at Pine Financial Group.
And I do have a report. We talked a little bit, Doug, about the economy, and we talked a little bit about private debt and private lending. So there's a free report I can give your listeners at thepinereport.com. And on that website, there's 2 reports. One, how to stay safe in private lending. So you could work with us. That'd be great. You could work with somebody else. That's great too. Or you could do it on your own and make more money, right? But what I don't want is you to go out there and do something stupid and lose all of your money. So we wrote a report. So we wrote a report to help you stay safe. What are the pitfalls to look out for? And the other report on there is comparing the 1990s crash to what we're seeing right now. And I think that's important because you mentioned it earlier on this call that real estate isn't always, you didn't say it directly, but you alluded to it. Real estate isn't always impacted in recessions. In fact, many times real estate is not impacted in a recession. 2020 is a great example. That was an official recession, right? It was announced a recession and real estate values went up. Okay.
Yeah.
But if you look at 2008, that recession, it hit real estate hard.
Yeah.
But that was a very unique recession. We can't compare the two. 1990, coming out of the savings and loans crisis, high interest rates, high inflation, that's much more similar to what we're experiencing today. So I compared the two and I wrote a report, and I'll give that away for free as well.
Great. And that's the link is what?
It's thepinereport.com.
Thepinereport.com. It's right below here. Click on that and get that. So yeah, let's I watched The Big Short again just for another book we're working on. And the author is talking about the next big thing, which is going to be even worse, right? There's more. Is there something coming up with all you mentioned earlier to the markets not being able to, recapitalize and whatnot? Are there a bunch of things coming due that aren't going to work?
Yeah, I think there's risks in two sectors. One I already mentioned is the banking.
Yeah.
I think banks are heavily invested in long-term low interest rate debt, both in like security, like treasuries and mortgages. Yeah. And here's the problem with long-term low interest debt. If you have to sell that asset, you have to take a discount. Yeah. Because why would someone buy a 2% return when they can go out and invest it in a savings account for 5%? Right. So you have to give them a discount on that asset to get it off your books. Yeah. So that's going to create tremendous losses to these banks if they have to liquidate. Yeah. So that's a risk, I think. These high interest rates really hurt banks, by the way. Hurts the government too. So the government is hurting their own self because they issue debt, right? So they issue debt that they have to pay back at higher interest rates. Do you know interest on government debt is higher than military spending now for the first time ever? So it's very scary if you think about it.
So sad.
The other thing I'm worried about is commercial, and it's mostly the commercial debt side, because when you have a commercial loan, you have to qualify cash flow wise. The property has to qualify cash flow. It's called a debt service coverage ratio. It has to produce enough income to pay back to pay the mortgage payment every month plus some. Usually it's a 1.2 or 1.25 debt service coverage ratio, which means 120 to 125% income off the property to the debt. Right. Yeah, I know I went kind of fast there, but
no, I got it. It's all right.
So when you have 3-4% interest rates, it might have a DSCR at 1.25 or 1.3 and qualify for the loan.
Yeah.
But now when it's coming due in 2024 or early 2025 and interest rates are 6 and 7%, that's twice what they have locked in now.
Yeah.
That DSCR might be, 0.7. And then the income on the property doesn't even pay the mortgage.
Yeah.
So the concern is banks they're regulated. They can't keep that on the books, right? They can't have non-qualifying loans on the books. So they either have to really reduce their interest rate or they're going to have to get rid of those assets, right? So I think that's going to create some problem in the commercial sector.
Maybe
I think housing is probably pretty solid because of the fundamentals, supply and demand. Those are fundamentals. I think the fundamentals in housing are very strong. So I'm not so concerned there. Yeah. I don't see a 2008. I just can't. I cannot paint that picture, and I'm dying to have someone paint it for me because I know there's fear, but I'm not seeing it.
Okay. I'll find out. We're working on a book, a woman who's starting a whole platform for the credit markets. And she's, painting a bleak picture about something coming up. So I'll have to get more details on it.
Consumer debt's probably where she's going because that is a concern. But here's the problem: all this because consumer debt is the highest it's ever been. Credit card debt is the highest it's ever been. Interest rates on these are 20%. Right? Defaults are starting to go up. But here's what we're missing. It's not adjusted for inflation. And you have wage inflation still outpacing actual inflation. That's why the economy is not going into a tailspin, because people are making more money. Right? So if you have inflation adjusted consumer debt numbers, it's not bad. Okay. So I would challenge her or anyone else to look at that.
All right. I like that. Ooh, I love talking to smart people. It makes my job so much more interesting and easy. So thank you so much, Kevin. I appreciate that. Pine Financial Group. Check it out, man. Get that get that paper, that book that he's got there. It's going to save your bacon or at least help you make more money. So that's very important stuff. So thank you, Kevin, for being on the show today. I really appreciate it. Stick around. I got some more stuff for you. Folks, if you have any questions, you can contact Kevin. You can download the show notes. You can get his book. Go for it. You'll be happy for it. Thanks so much. Have a great day.
Thanks, Doug.